FOMC, the Federal Open Market Committee, is less than 24 hours away. This is a very turbulent time and a volatile period for markets, and it's best to be prepared and know what the important points are as we head into the next 24 hours. If you don't know what this is, the FOMC is where the central bank in the US, the Federal Reserve, gets together and they discuss some of the big factors regarding the economy like inflation, unemployment, and they will make an update to the interest rate. And we know how markets generally interplay with interest rates. They feed liquidity. When interest rates are going down, it is easier for liquidity to come into markets. When they are going up, it becomes a more expensive ordeal to bring liquidity into markets, and it raises the cost of capital. These factors have a lot of other mechanisms and things that you can discuss, but this is the general implication of interest rates changing, and therefore markets tend to react to this update. So as we come into this event, I want to remind you all, it is not necessarily what they're going to do, but it's how the market will interpret what they do and what they say. What I mean by that is it's not actually a big surprise what they're going to do tomorrow, and I'll show you this in a moment. What is a surprise is the unscripted moments in question time, the statement having little comments in it that maybe the market hadn't quite priced in yet. These little factors tend to push the market one way or another much more than what you will just see the general policy update will do. So this is the CME FedWatch tool. It aggregates the market probabilities based off the Fed funds futures. So what the market is essentially pricing in for the FOMC tomorrow. So we can see the current rate is 350 to 375 basis points. And this bar chart here represents the different outcomes based off the probability of the market. And we can see the 350 to 375 is coming in at 98.9% probability. So this is saying with virtually 100% probability, we're not going to get a cut or a hike tomorrow. It's just going to stay steady. A 1.1% chance of a hike. The thing that I have always found with the CME FedWatch tool is it never misses, right? So like I said before, it's not a surprise what comes out as far as the interest rate update. And I find it pretty humorous seeing people online trying to make these big calls about what they're going to do at FOMC right beforehand. And it's like, you literally just have to hop on CME FedWatch and it'll tell you what they're going to do. So don't expect a cut or a hike tomorrow. Just expect them to remain steady with interest rates. And when we look at the probabilities chart here, this tells us sort of what the market is pricing in at the moment. So we can see this is the next handful of FOMCs and the most probable outcome per the market at the moment. So we can see this is the FOMC tomorrow and 350 to 375 basis points. So no cut or hike. And in the blue is just the most probable outcome per what the market is priced in. So as we can see, they're not predicting a rate cut or hike for the entire year pretty much until we get to December. That's when they're predicting a 25 basis point cut. And then again, just remaining steady until all the way into 2027 at the pretty much the end of the year will be the next rate cut per the market. Now, this always changes. So really getting more than one or two FOMC in the future is not really going to be accurate at all. But it is interesting to observe because it tells you what the market is generally thinking for the next 1 or 2 years for interest rates, and by extension, inflation and unemployment, and sort of just where they're viewing these general macroeconomic factors. So at the moment, it's very obvious that they're anticipating that inflation is going to be sticky, but there's probably some stresses on the employment front and a need to prop markets up to some degree. So they're sort of in this tight range from the market's point of view where they can't really cut or hike. They just got to kind of keep things steady. If you go back in the past, you would have seen that this had a much different curve where interest rate cuts were literally predicted for all of this year, and heading to much lower, I think around sort of getting to this target around the end of this year, not the end of next year. So you can see that the expectations for interest rates have definitely changed in recent times. So then I want to take you guys to, this is the yield curve chart. So this is on TradingView. You can look at yield curves. What yield curves do is they essentially plot the entire yield for different dated bonds. So this is in the US, and we can see we have the 1 month, the 3 month, the 6 month, the 1 year, the 2 year, the 3 year, the 5 year, the 7 year, 10 year, 20 year, and 30 year. The 3 lines here represent 1 month ago, 1 week ago, and the current yield curve. So to go through this, I don't want to spend a long time explaining what yield curves are and sort of what the purpose of them is, but I just want to talk about the changes and what they mean and how this best informs us what's going to happen at FOMC. So we can see we've had a flattening of the curve in the last month, especially on the 2-year yield. So we can see over a month ago it was sitting at 3.4%. It's now at 3.6%. And we can see, generally speaking, the entire curve has shifted upwards. This tells us that the market is pricing in higher inflation for longer. And where a month ago, or even, you could go 6 months ago, this would look even further, down from where it is now, they were pricing in that inflation would sort of stay low and that we would, eventually come into a period where we would be cutting interest rates. This is changing now, right? And we're seeing that the recent events on the geopolitical front are shifting the mindset of market participants, where things like oil spiking with everything that's happening in Iran is clearly causing people in the market to price in higher inflation. And this isn't a groundbreaking revelation. Oil is very inflationary when it goes up, because fuel generally just gets everything going in the world. And if fuel is more expensive, then things that need to be transported are inherently more expensive as well. And this just sort of bows out in a big butterfly effect into everything. So the 2-year yield going up is essentially telling us that they are pricing in a higher inflation for longer and the need for less cuts. And I think the bond market generally is the thing that will tell you how the market's going to react to FOMC. Generally, if you get these sort of bear steepenings, they're called, and sort of the long end going up and sort of flattening out of the curve into FOMC, generally the market is preparing for a pretty bearish event. And that's the way that I'm positioning for this. I do think there is a greater probability than not that the things that are spoken about at FOMC are not very bullish, and the market isn't going to love what they're going to come out and talk about. And the yield curve is kind of representing that by having this sort of flattening at the 2-year. And then also, if you look at sort of the 20-year and 30-year, how much they've gone up as well, almost the same amount as the 2-year. So it's kind of a bear steepening and also like a bear sort of flattening of the belly. But nonetheless, all the yields going up is just not a great sign overall for markets. Some things I want to talk about very briefly. This is the ICE BOFA US High Yield Index Option Adjusted Spread. This is the credit spread, essentially. One thing that is a bit concerning for the macro markets in the US is the credit spreads are putting in multi-year highs. So we can see we've eclipsed the November high and October high and the August high of last year. I wouldn't say, sorry, multi-year high, but multi-month high. And sort of breaking, if you were trading this, a bit of a resistance area through here. And what we see when credit spreads start to creep up, some pretty big market downturns can come from that. And we're coming from a pretty historic low, which is concerning because you go back in time and you sort of look at periods where the credit spread has been shooting up, 2021 into 2022, not a great time. The start of COVID, the credit spread absolutely ripped up, and then you can go really far back to 2007 and sort of what was happening there, and to 08. So it's not necessarily saying 08 style event is going to happen, but just the fact that we're sort of crawling out into multi-month highs on the credit spreads is not a good sign for macro markets. When we look at Bitcoin, The thing that I'm looking at on the 4-hour is this bearish butterfly. We've recently hit it as we've come up to where's the level, 75, 100, and really I do think sort of 75 is the general sort of area of resistance that might cap Bitcoin for now and might send us down to like 64, 60, 3K again. Might spend a little bit of time up here, but I think you're kind of rammed up against it at the moment. There is a daily level at 73.8, but the fact that we're above it, I'm not overly optimistic. It really reminds me a lot of what was happening back in this period throughout December of last year and January of this year, where you had this level around like 92, 93K. And although, we eclipsed it a few times, every time we just roll back over, right? And I wouldn't be surprised if that's sort of what we're dealing with here. And we've got this bearish harmonic at this level. So for me, I'm seeing this as we're at resistance, and you're probably at a high value area for a short to resume this trend back down. And I think even if you're, speculating that this is a trend reversal, you probably would want to see some kind of higher low get put in on this just to sort of confirm that, okay, like the market structure is sort of on its way upwards. So you're going to have to wait for that to come in. So I think at a minimum, we get some kind of 382 retracement off this, and that would put us around 70K, 71K, and we'll sort of see what happens there. But that's my sort of base case on Bitcoin. When I look at the NASDAQ, it's looking like a pretty bleed out scenario. We're just sort of like grinding lower, and I do think a potential sort of greater breakdown to maybe as low as like 22K is very much on the cards here. I just don't see any value here for longs on the NASDAQ, and it's like, yeah, maybe rip higher and whatever, but like you've just been grinding sideways for such a long time and sort of down after such an impressive uptrend. You just want to see this come into some pocket of value. Can it do like a 1618 locally, something like that, down to like 22, hit the 382 of this massive trend, like do something like that? Because to be frank with you, I'm feeling like this guy up here looking at this sideways chop action, it's trendless, it's mind numbing, and until you get something a bit more substantial as far as a pullback, it just doesn't look great. And I think with how the macro is shaping up, you are, I think, at risk of a bigger breakdown sooner rather than later. Potentially FOMC is one of the catalysts and sort of things that pushes this forward towards some of these downside targets. So that's what I'm looking at for the next 24 hours, some of the bigger charts and how they're sort of shaping up in the midst of this. Hope this was helpful. If you're trading around FOMC, understand that hour before and after is going to be very volatile. If your strategy cannot persist through that volatility, then just sit it out, right? But otherwise, if it's your game, then obviously mark out your levels, drop to the lower time frames, know what to expect, and be ready to take some action. Whatever you do, just make sure that you are being smart about it and understand the gravity of the event and what it can bring into the markets. So I hope that was helpful, guys, and I'll see you guys around. Take care.